There is a company worth nearly $1 trillion that you cannot buy a single share of. Not because it doesn't exist, not because it's some shadowy hedge fund, but because the people who got in early, Amazon, Google, Sequoia Capital, they made sure the door stayed locked until they were done loading up. And now finally, that door is cracking open. Anthropic just filed its IPO paperwork with the SEC on June 1st, 2026. The company behind Claude, the AI that millions of people use every single day, is heading to public markets. And the question every working American needs to sit with right now is not, is AI real? It obviously is. The question is, when you finally get to buy in, will you make money? Or will you be the last one holding the bag? Before we dive in, I need to be clear, I am not a financial advisor. This video is for educational purposes only. Investing involves risk, so always do your own research before making any financial decisions. Oh, because here's the thing nobody is leading with in these breathless IPO headlines. Anthropic is projecting a $26 billion revenue target for 2026, but don't let that number fool you, because on the other side of that ledger, the company is still burning cash at a staggering rate, has raised over $30 billion in funding, and is targeting its first profitable quarter as early as mid-2026. So you've got a company valued at nearly $900 billion on paper, spending faster than it earns, and now it's eyeing an IPO. The question nobody's asking is, who's actually buying this dream? And I'll show you exactly why that gap between the hype and the reality is the most important thing to understand before this IPO hits. But first, you need to understand what Anthropic actually is and how it got here. Because the story is wilder than the headlines. Anthropic was founded in 2021, not by some college dropout in a garage, by a group of researchers who walked out of OpenAI, the company behind ChatGPT, because they thought OpenAI was moving too fast and too recklessly with AI safety. Oh, let that sit for a second. The people who built some of ChatGPT's earliest models looked at where OpenAI was heading and said, we need to leave and do this differently. That's your founding story. A company born from a safety disagreement inside the most famous AI lab in the world. Fast forward to today. Anthropic's Claude models are embedded inside Amazon's cloud infrastructure, used by over 300,000 businesses, and generating revenue that has gone from essentially zero to a $47 billion annualized run rate in roughly 18 months. In January of 2024, their annualized revenue run rate was $87 million. By May of 2026, it had crossed $47 billion. That is, and I want to be careful here because this number sounds made up, roughly a 530-fold increase in run rate revenue in about a year and a half. I know how that sounds, but the data is real. No major technology company has ever reported a publicly documented revenue ramp at that velocity. Not Amazon Web Services, not Salesforce, not Google Ads in its prime. And that is the part that makes this IPO genuinely historic and genuinely dangerous for retail investors who aren't paying attention. Here's what nobody's talking about in the coverage this week. The valuation math behind Anthropic's IPO is unlike anything public markets have ever been asked to price. The company just closed a $65 billion Series H funding round. That's the last private fundraising round before going public, at a valuation of $965 billion. Bankers are telling the information they're eyeing a listing price that takes the company above $1 trillion. That would make Anthropic, on day one of trading, one of the 15 most valuable companies in human history. More valuable than Tesla, more valuable than Berkshire Hathaway, more valuable than Walmart, which has been selling things to American families for 60 years. And you can't own a single share yet, unless you're an accredited investor with the right connections. The Sequoias and Coatus of the world are already sitting on paper gains that would make your head spin. And now, very generously, they're ready to let you buy in too. By the time this hits Robinhood and SoFi, And yes, both platforms have historically offered IPO allocations to retail clients. The institutional money will have already priced in a lot of the upside. So let me ask you something that's worth sitting with before we go any further. At what price does the story stop being a growth story and start being a speculation story? How much future growth is already baked into a $1 trillion valuation for a company that won't be profitable for at least 2 more years? Keep that question in the back of your mind. We're coming back back to it. Here's the mechanism, the actual engine underneath all of this. Think about it like a restaurant that's spending $12 to make every meal it sells for $10. You're losing money on every plate. But here's the thing. Every month that goes by, the cost of the ingredients drops, and the restaurant gets more and more customers so it can buy in bulk. Eventually, the cost drops below $10, and suddenly every single customer becomes profitable. That's the bet Anthropic and every major AI company is making. The cost of compute, the chips, the servers, the electricity, the data centers, is expected to keep falling as the technology matures. Revenue is supposed to compound faster than the burn rate, and whoever is still standing when costs fall and revenue holds, they win enormous. That is not a crazy bet. It worked for Amazon Web Services. It worked for Netflix. But it's also the exact same logic that wiped out a generation of investors in the late 1990s. And this is the part of the story most people are missing. This has happened before. In 1999 and 2000, the internet was completely real. Email was real. E-commerce was real. The whole world was going to change, and it did. But between 1995 and 2000, over $5 trillion of investor wealth was created on paper through tech stock valuations. And then, between 2000 and 2002, roughly $3.8 trillion of that wealth evaporated. Pets, Com, Webvan, Cosmo.com. These weren't fake companies selling fake products. They were real companies with real technology that simply could not turn a profit fast enough before the money ran out or the market lost patience. The technology won. Most of the early investors lost. Go back even further. The railroad boom of the 1880s and 1890s. Railroads were the most transformative technology of the 19th century. They connected America coast to coast. They enabled mass commerce. They were absolutely, undeniably real. And between 1893 and 1895, 156 railroad companies went bankrupt. The technology survived. The shareholders of the early speculative plays often didn't. And here's the specific insight that should make you pause on the Anthropic IPO. A technology being real, even being world-changing, does not guarantee that the people who buy the stock at peak valuation will make money. The fiber optic cable companies of the late 1990s laid the infrastructure that literally runs the modern internet. Corning, Global Crossing, 360 Networks. The internet needed that fiber. The companies that built it mostly destroyed their investors. Now Anthropic is not Global Crossing. The comparison isn't that clean, but the principle is worth understanding before you put a single dollar near this thing. Here's what the mainstream isn't saying loudly enough. The revenue numbers Anthropic is reporting are run rate figures, not audited annual revenue. Run rate means they take what they made in the most recent month, multiply by 12, and call it the annualized number. So when they say 47 billion in run rate revenue, that means in the most recent month before the S1 filing, they made roughly $4 billion. That's real money, but it's not the same as saying they earned $47 billion over the past 12 months. The S1, the full public filing, is what will show us the real unaudited numbers. Gross margin, cash burn, customer concentration. And this is critical. There are analyst estimates suggesting that Anthropic's top 10 enterprise customers account for 40 to 50% of all their revenue. One major client, say a Fortune 50 company that decides to switch to Google's Gemini, could create a visible quarterly miss in the very first earnings report after going public. That is not a small risk for a company trading at $1 trillion valuation. There's another piece of this that is, and I mean this, genuinely unprecedented. It's the governance structure. Anthropic is not a regular corporation. It's incorporated as a public benefit corporation. That means by its own charter, it has to balance shareholder profit with its mission of building AI safely. In theory, Anthropic's board could make a decision that's good for AI safety and bad for short-term stock performance, and that would be legal and within the company's mandate. Has any company ever gone public at $1 trillion valuation with that kind of dual obligation legally baked in? No. Try explaining that one to Wall Street on a bad earnings quarter. We have no historical playbook for what happens when those two priorities conflict inside a public company with millions of ordinary shareholders expecting quarterly growth. And then there's the Pentagon situation. In February of 2026, Defense Secretary Pete Hegseth designated Anthropic A, and this is the official language, supply chain risk to national security. Why? Because Anthropic refused to allow Claude to be used for fully autonomous weapon systems or domestic mass surveillance. The Trump administration ordered all federal agencies to stop using Anthropic's technology. A court has temporarily ruled the government overstepped its authority, but that fight is not over. No major US technology company going public has ever had a federal national security designation on the books at the time of its IPO. That's not a headline risk, that's a structural risk, and it belongs in every conversation about this stock. So what does the next 6 to 24 months actually look like? Let's game it out. Both directions. The bull case, and it is genuinely compelling, goes like this. Anthropic's gross margin improved from negative 94% in 2024 to around 40% by 2025. If that trend holds, and if compute costs keep falling the way AI infrastructure costs have historically fallen, then by 2028 Anthropic could be generating $17 billion in free cash flow annually. Claude Code, their AI coding assistant, went from 0 to over $2.5 billion in annualized revenue within its first year of public availability. Enterprise customers are embedding Claude into their core operation, which creates switching costs and pricing power. If the S1 shows clean audited numbers that confirm the run rate story, this could be the generational IPO that skeptics miss out on. The bear case is also real. The model lead Anthropic has today, their edge on technical benchmarks like SWE Bench, which measures how well an AI can write code, is roughly 2 percentage points ahead of GPT 5.5. Historically, AI capability gaps of that size close within 8 months. If a competitor catches up before Anthropic locks in long-term enterprise contracts, the pricing power story falls apart fast. Add the Pentagon risk, add the unresolved copyright lawsuits, add the tens of billions in committed compute infrastructure spending across deals with Google, Amazon, and Broadcom that has to be serviced regardless of revenue. Add the fact that you'd be buying at a $1 trillion valuation with no audited profits on record. Well, let me be more careful here. This is not a situation where the risks are small or academic. They're structural, they're real, and they deserve to be weighed seriously. Here's the part that should make you sit up straight. The story of Anthropic isn't just the story of one company. This IPO, along with OpenAI's expected filing and SpaceX's listing that's happening this month, is what one Wedbush analyst called the opening of the floodgates for the IPO market. These 3 listings could represent the largest simultaneous concentration of capital ever brought to public markets at the same time. An analyst quoted by CNBC this week said, "This 2026 window either becomes the most consequential IPO cycle since the dot-com era, or the most expensive lesson in narrative versus fundamentals that public markets have ever taught." That sentence should be on a poster. Because here is the aha moment, the thing I want you to actually think about and maybe send to someone. Anthropic made $87 million in annualized revenue in January of 2024. 18 months later, they're reporting $47 billion. That's a real number. But the valuation has gone from $4 billion in early 2023 to nearly $1 trillion today. Revenue grew roughly 500 times in 18 months. The valuation grew 240 times in 3 years. The valuation got there faster than the revenue did. Which means the stock price at IPO is not just pricing in what Anthropic has done. It's pricing in flawless execution of everything they might do over the next 5 to 10 years. And public markets have a way of being very unforgiving when flawless execution hits even a single stumble. This is the pattern retail investors have seen before, and it's worth asking directly. At what point does the story stop being investment and start being speculation? So what can you actually do with this information? Not investment advice, awareness and options. First, understand that you will have access to IPO allocations through some retail brokers when the public S1 drops and the roadshow begins. SoFi and Robinhood have historically offered these. But understand what you're buying into: a company with extraordinary revenue growth, a genuinely transformative product, a complicated governance structure, real federal legal exposure, and a valuation that has no precedent in modern financial history. Second, if Anthropic's story interests you, recognize that public companies already have skin in this game. Amazon is Anthropic's biggest cloud infrastructure partner and has invested billions. Alphabet, Google's parent, is a major investor and compute partner. Nvidia's chips power Claude. None of these are pure Anthropic plays, but they're also not priced at $1 trillion on the promise of future profitability. Third, Third, and I cannot stress this enough, wait for the full public S1. The confidential filing tells us the IPO is coming. The public S1 will tell us audited revenue, actual gross margins, customer concentration, the real cost structure, and the governance terms. That document is the thing that serious investors will actually read. Everything before that is noise. And fourth, go read about what happened to Rivian, Palantir, Snowflake, and Uber in the months after their IPOs. Not because those companies are comparable to Anthropic, but because the pattern of hyped IPOs experiencing significant post-listing drawdowns is well documented and worth knowing. IPO day price is almost never the best entry point for a retail investor who doesn't have institutional allocation. Look, here's where I land on this. Anthropic is not a fraud. Claude is not a fad. The technology is real, the revenue ramp is real, and the enterprise adoption is genuine. But real technology and profitable investment are two different things, and the history of transformational technologies going public at peak enthusiasm is not a comforting read. The railroads were real. The fiber was real. The dot-com companies were building the actual internet. The question isn't whether AI changes the world. It already has. The question is whether you, buying in at whatever price this hits public markets, are positioned to benefit from that change, or whether you're buying the dream at a price that already reflects the dream coming perfectly true. Stay curious. Read the S1 when it drops publicly. Understand what you're actually buying before you buy it. And if you're going to be part of this moment in financial history, be an informed part of it, not an emotional one. What do you think? Drop it in the comments. Is Anthropic's IPO the opportunity of the decade, or the setup for the most expensive lesson public markets have ever given retail investors? I genuinely want to know where you land on this.